The perfect relative strength index trading strategy is not a single indicator signal but a multi-layered system built on optimized settings and robust confirmation filters. Relying on the default 14-period relative strength index with the standard 30 and 70 levels is a common mistake that plagues novice traders. These generic settings frequently generate false signals, especially when a market enters a strong, sustained trend where price can remain overbought or oversold for extended periods. The true path to profitability involves moving beyond this basic configuration and incorporating sophisticated technical analysis. The problem with default settings is their inability to adapt to varying market conditions, leading to countless premature entries and unnecessary losses. During a powerful uptrend, the relative strength index might linger above 70, signaling overbought conditions that never lead to a meaningful reversal, causing a short seller to be continuously squeezed. Conversely, in a sharp downtrend, the indicator can stay below 30 for weeks, trapping buyers who attempt to catch the falling knife based solely on the oversold reading. This fundamental flaw necessitates a significant overhaul of the indicator's application, moving away from a single-point decision-making process. The solution to achieving a perfect relative strength index strategy is to construct a system that uses the indicator as a momentum guide, not a definitive entry signal. This involves a three-stage approach: optimizing the indicator's period and overbought, oversold levels, confirming signals with specific price action and volume, and filtering trades based on the overarching market trend. Only by combining these distinct layers can a trader transform the basic relative strength index from a noisy tool into a high-probability reversal and continuation instrument. This advanced framework ensures that a trader is acting on confirmed momentum shifts within the context of the larger market structure, dramatically improving signal quality. The thesis for this perfect strategy is clear. High-probability trading combines optimized periods, trend-based confirmation, and specific divergence rules for entry and exit. We must first tune the relative strength index to the specific time frame and asset being traded, recognizing that one setting does not fit all market environments. Next, we must layer on confirmation techniques, with divergence being the most powerful reversal signal the indicator can offer, provided it meets strict criteria. Finally, all trades must pass through a strict trend filter, ensuring we are trading with the path of least resistance rather than fighting the primary market movement. The first critical component of this superior strategy involves optimizing the relative strength index settings and redefining the true overbought and oversold levels for the instrument in question. The generic 14-period setting is merely an arbitrary starting point, one that rarely provides the cleanest signals across all trading styles and assets. The length of the look-back period must be tailored to the trader's intended holding time and the volatility of the underlying security to capture the most relevant momentum data. This customization is essential because the market's breathing cycle varies significantly between a volatile cryptocurrency and a stable blue-chip stock. For the active day trading or scalping style, a shorter period is absolutely necessary to capture the rapid momentum shifts that define these short-term strategies. Using a relative strength index 9 or relative strength index 10 allows the indicator to react much faster to short-term price movements on a 5-minute or 1-minute chart. This sensitivity is crucial because a day trader needs to enter and exit within minutes or hours, and a slower 14-period setting would introduce too much lag, causing entries to be late and profit potential to be missed. The shorter look-back period provides the necessary responsiveness to trade the quick, high-frequency swings inherent in intraday charts. Conversely, swing traders who hold positions for days or weeks require a smoother, less volatile reading to identify intermediate trend movements. For this style, the traditional 14-period setting remains a solid foundation, but extending it to 21 periods can often provide a cleaner, more reliable signal, The 21-period relative strength index filters out a significant amount of the short-term noise, allowing the swing trader to focus on broader momentum shifts that align with their multi-day time horizon. This deliberate smoothing helps to avoid reacting to minor fluctuations that do not represent a true change in the underlying market sentiment. Once the period is optimized, the next step is adjusting the overbought and oversold levels away from the standard 70 and 30, which are often too conservative for modern, high-volatility markets. For extremely short-term charts, such as a 5-minute or 15-minute time frame, the market noise can cause the relative strength index to constantly clip the 30/70 boundaries without any subsequent reversal. To filter out this noise and focus only on extreme momentum readings, the levels should be adjusted to 75 for overbought and 25 for oversold. This adjustment ensures that a signal is only generated when the buying or selling pressure is truly at an unsustainable extreme, leading to higher quality reversal trades. This advanced technique, known as the True Relative Strength Index method, moves beyond arbitrary numbers and finds the levels specific to the instrument being analyzed. The method involves manually reviewing the chart and identifying the recurring reversal level, the precise point where the last 4 out of 5 significant bounces or reversals occurred. It is not uncommon to find that a particular stock consistently reverses when its relative strength index hits 82 and 18, entirely outside the standard 30/70 range. By using these customized true relative strength index levels, the trader is aligning their strategy with the actual historical behavior of the asset rather than a generic setting. The True Relative Strength Index technique is a powerful exercise in market specificity, demanding that the trader treat each asset as a unique entity with its own momentum signature. This approach recognizes that the volatility and trading patterns of a highly liquid currency pair will differ vastly from those of a low-float small-cap stock. By identifying that a security's true oversold region is perhaps 22 instead of 30, the trader avoids premature entries and waits for the deepest, most exhausted selling before committing capital. This personalized optimization process significantly reduces the frequency of false signals, which is the hallmark of a truly perfect strategy. The second core component focuses on the highest probability setup the indicator offers, the confirmed divergence. Divergence is the most reliable signal the relative strength index can generate because it indicates a fundamental disagreement between the price action and the underlying momentum, signaling a potential trend exhaustion. This setup is not merely a level crossing, but a structural shift in the market's internal strength, making it a far superior entry criterion than simple overbought or oversold readings. A perfect strategy must place divergence at the center of its reversal methodology. Bullish divergence, which is a powerful buy signal, occurs when the market price creates a lower low, but the relative strength index simultaneously creates a higher low. The price action suggests that sellers are still in control, pushing the price to new lows. But the relative strength index signal reveals a crucial detail. The indicator's inability to match the new price low demonstrates that the selling momentum is significantly weakening, suggesting that the bears are exhausted and a reversal is imminent. This contradiction between price and momentum is the exact setup a high-probability trader seeks to exploit. To correctly define bullish divergence, one must meticulously plot the swing lows on both the price chart and the indicator window. The price must clearly print a trough that is lower than the previous trough, confirming the current downtrend is still technically in force. Simultaneously, the relative strength index must print a trough that is noticeably higher than its previous trough, providing the visual evidence of weakening selling pressure. This specific configuration is the required precondition for a long trade, but it is not by itself a sufficient entry signal without further confirmation. Conversely, bearish divergence, which is the signal for an impending sell-off, occurs when the asset price creates a higher high, yet the relative strength index creates a lower high. The price action suggests that buyers are still pushing the market to new peaks, maintaining the appearance of an uptrend. However, the relative strength index signal reveals that the buying momentum required to push the price higher is waning with each successive peak. This loss of momentum is the early warning sign that the current uptrend is losing steam, and a significant correction is likely to follow. The correct identification of bearish divergence requires a careful comparison of successive swing highs. The price chart must show a peak that is clearly higher than the preceding peak, confirming the continuation of the current uptrend. At the exact same time, the relative strength index must show a peak that is lower than its corresponding previous peak, explicitly demonstrating the loss of upside momentum. This structural discrepancy is a strong technical cue, but it is still only the first step in the perfect strategies execution checklist, demanding further confirmation. The perfect step in utilizing divergence involves mandatory confirmation filters, recognizing that divergence alone can still be a false signal, especially in extremely fast-moving markets. The trader must wait for the market itself to confirm the shift in momentum through specific, measurable price action before initiating a trade. This rule prevents the trader from entering prematurely based on the indicator alone, which is a common mistake that leads to large losses when a trend simply pauses before continuing. The confirmation filter transforms a potential signal into a high-conviction trade setup. The most crucial of these confirmation filters is specific price action confirmation, requiring the formation of a recognizable candlestick reversal pattern at the point of divergence. For a bullish divergence, the trader must see a clear bullish engulfing pattern, a hammer, or a piercing line pattern form right at the low where the divergence is confirmed. For a bearish divergence, a shooting star, a bearish engulfing pattern, or a dark cloud cover must appear at the high. These candlestick patterns provide immediate visual evidence that the market participants have accepted the momentum shift and are actively reversing the price. Another powerful and often overlooked confirmation filter is volume confirmation, particularly relevant for bearish divergences. When a bearish divergence is forming, the price is making a new high, but the underlying buying strength is supposed to be weakening. This weakening strength should be reinforced by observing decreasing volume on the new price high. If the new high is made on significantly lower volume than the previous high, it strongly reinforces the idea of waning buying power, making the divergence signal much more reliable. Conversely, if the new high is made on strong, increasing volume, the divergence is often unreliable and should be ignored. A critical aspect of any perfect strategy is having a clear, non-negotiable exit rule, and for divergence trades, a common and effective rule relates back to the relative strength index's neutral zone. A typical exit rule is to take profit when the relative strength index re-enters the neutral zone, which is generally considered to be the area between 40 and 60, centered around the 50 level. When the indicator crosses back into this zone, it signals that the initial extreme momentum has subsided and the trade has likely captured the majority of the reversal move. This rule provides a systematic, objective method for taking profits without relying on emotion or guesswork. The third essential component of this high-probability system is the trend-following filter, which prevents the trader from attempting to catch reversals against an overwhelmingly powerful market trend. The biggest drawdowns often occur when a trader attempts to short a market that is in a parabolic uptrend, simply because the relative strength index is overbought. The trend filter ensures that all trades are aligned with the path of least resistance, significantly increasing the probability of success for every single entry. This component is the market structure layer that adds context to the indicator's signals. The simplest and most effective way to implement this trend filter is by using a long-term moving average, such as the 200-period or 200-day moving average, which is a universally recognized benchmark for long-term market direction. The rule is absolute. Only take long trades when the price is trading above the 200-period moving average. and only take short trades when the price is trading below it. This single filter immediately eliminates all counter-trend trades, protecting the trader from the forces of a powerful, established market movement. It transforms the relative strength index from a reversal tool into a powerful pullback trading tool. Once the overall trend is established, the strategy focuses on trading pullbacks within that trend, using the relative strength index's 40 to 60 zone as a key signal, ignoring the 30/70 levels entirely. In a strong uptrend, for example, the market rarely dips low enough for the relative strength index to touch the 30 oversold level because the buying interest is too strong. When the relative strength index does hit 30, it often signals a major correction or a trend change, which is not the optimal place for a trend-following entry. The perfect uptrend strategy looks for a healthy, shallow pullback, not a deep, potentially dangerous one. The specific buy signal for a pullback in an uptrend is to ignore the 30 oversold level and instead wait for the relative strength index to dip to the 40 to 50 zone and then cross back above 50. The dip to the 40 to 50 zone represents a temporary pause or a mild profit-taking phase within the larger trend, indicating a healthy retracement. The cross back above the 50 level is the crucial re-entry signal, confirming that the short-term selling pressure has subsided and the momentum is shifting back in favor of the prevailing uptrend. This setup is a high-probability continuation trade, capitalizing on the market's natural rhythm. Similarly, when the market is in a confirmed downtrend, the strategy ignores the 70 overbought level, as the selling pressure will usually prevent the market from rallying. That high A rally that pushes the relative strength index to 70 in a strong downtrend is often a deep retracement that might signal a potential trend change, making it a poor place for a continuation trade. The perfect downtrend strategy looks for a healthy, shallow rally that provides a better entry point for a short position, anticipating a continuation of the primary move. This selective entry process is what separates the expert from the novice. The specific sell signal for a pullback in a downtrend is to ignore the 70 overbought level and instead wait for the relative strength index to rally to the 50 to 60 zone and then cross back below 50. The rally to the 50 to 60 zone represents a temporary relief or short covering rally within the larger downtrend, a natural consolidation phase. The cross back below the 50 level is the critical signal, confirming that the short-term buying pressure has failed and the momentum is resuming its path downward in line with the primary downtrend. This strategy focuses purely on continuation trades, which statistically have a higher probability of success than reversals. This trend-following approach, centered on the 40 to 60 zone, is a sophisticated application of the relative strength index that moves beyond its original reversal intent. It treats the 50 level as the equilibrium point, or the battleground between bulls and bears, where a move back across it signals a win for the trend's dominant force. By only entering trades when the indicator is moving away from the 50 level in the direction of the 200-period moving average, the trader is capitalizing on momentum that has already been confirmed by the market structure. This method drastically reduces the risk of fighting a trend and increases the average profit per trade. To illustrate the power of a rules-based optimized relative strength index strategy, we turn to a specific historically validated system, the Connors Relative Strength Index 2 strategy. This strategy is a prime example of how taking a simple indicator, optimizing its period to an extreme, and combining it with strict trend and price action rules can create a high-performing system. The Connors Relative Strength Index 2 is a mean reversion strategy specifically designed for short-term trading in liquid indices and stocks, proving that optimization is the key to perfection. This case study demonstrates that a perfect strategy is defined by its specific non-discretionary rules. The strategy overview reveals a clear focus on extreme short-term oversold conditions within the context of a strong established uptrend. It is a counterintuitive approach that goes against the common advice of buy low, sell high, by instead attempting to buy extremely low in a high market. This is a pure mean reversion approach, betting on the statistical probability that a market that has sold off aggressively for 2 periods will snap back quickly to its average price. This approach minimizes market exposure and maximizes the probability of a quick, profitable recovery trade. The specific rules for the Connors Relative Strength Index 2 strategy involve 3 main indicators working in concert. The first indicator is the 2-period Relative Strength Index, which is the core momentum engine, providing an extremely sensitive reading of short-term price changes. The second indicator is the 5-day moving average, which serves as the primary exit mechanism for the trade. The third indicator is the 200-day moving average, which acts as the crucial long-term trend filter, ensuring all trades are placed only in an overall bullish environment. This layering of indicators creates a highly robust system. The buy setup for the Connors Relative Strength Index 2 is highly specific and must meet 2 absolute conditions simultaneously. First, the price must be trading above the 200-day moving average, confirming that the market is in a long-term uptrend and that any sell-off is likely a temporary pullback. Second, the 2-period Relative Strength Index must close below the level of 5, which is an extremely low, deep oversold reading that signals a statistically rare, short-term selling exhaustion. Both conditions must be met on the same day for a valid entry signal to be generated. This setup is the definition of a high-conviction trade because the strategy is only executed when the market is statistically stretched to its limit within a confirmed long-term trend. The use of the 2-period Relative Strength Index below 5 is the mathematical edge, identifying a selling intensity that rarely lasts more than a day or two before a violent snapback occurs. The 200-day moving average acts as the safety net, guaranteeing that the mean reversion attempt is occurring in a favorable bullish environment. This extreme level of precision is what makes the strategy so successful. The exit rule for the Connors Relative Strength Index 2 is equally simple and non-discretionary, which is vital for any strategy that works perfectly. The trade is held until the price closes above the 5-day moving average, which serves as the short-term mean. The moment the price crosses back above this short-term average, the mean reversion trade is considered complete and the position is immediately closed. This rule ensures that the trader captures the quick snapback profit and avoids holding the position into potential further consolidation or reversal. The historical backtest evidence for the Connors Relative Strength Index 2 strategy is perhaps the most compelling argument for its perfection. Studies have cited historical backtest results over 34 years on the S&P 500, showing a remarkably high win rate and strong risk-adjusted returns. These results demonstrate that a simple, non-discretionary strategy, when properly optimized and filtered, can consistently outperform buy and hold investing with significantly less risk. The evidence proves that the edge lies not in complexity, but in the specificity and optimization of the rules applied to the relative strength index. This backtesting validation confirms that the strategy's edge is persistent and robust across multiple market cycles, including bull markets, bear markets, and periods of consolidation. The high win rate is a testament to the power of combining an extreme oversold condition, relative strength index 2 below 5, with a strong trend filter above the 200-day moving average. This case study provides a concrete, actionable blueprint for traders seeking to move from conceptual understanding to profitable statistical trading. It is the ultimate proof that the relative strength index can be the foundation of a highly effective strategy. In conclusion, the truly perfect relative strength index strategy is a synthesis of a multi-layered approach, a far cry from simply buying at 30 and selling at 70. It is a comprehensive system that uses the indicator as a highly sensitive measuring tool within a larger framework of market structure and statistical probability. The perfection is found in the layering of three distinct powerful components that work together to drastically increase the signal-to-noise ratio. This systematic approach is the only way to achieve consistent long-term profitability in the financial markets, moving beyond chance and into the realm of statistical trading. The successful strategy is built upon the foundation of optimized settings, where the period is tuned to the trading style and the overbought, oversold levels are customized to the asset's true relative strength index. This is followed by the high probability entry filter of confirmed divergence, which requires specific candlestick and volume confirmation before a trade is initiated. Finally, all signals are screened through the trend following filter, utilizing a long-term moving average and the 40 to 60 zone strategy to ensure every entry is aligned with the prevailing market direction. This holistic method is the core of the perfect relative strength index system. However, the final non-negotiable rule that truly makes any strategy work perfectly is the application of robust risk management and non-biased backtesting. Even the most statistically sound strategy will fail without a clear defined stop-loss placement and proper position sizing that protects capital from unexpected market events. The strategy must be subjected to rigorous walk-forward testing, proving its effectiveness on new, unseen data to ensure it is not merely curve-fitted to the past. The combination of a mathematically sound strategy and disciplined risk management is the final crucial element that elevates a system from good to perfect.